This time around, we decided to go with the mining company, United States Lime and Minerals. It is Simplot.
So we're recommending a hold after our research. Its current price is $80 today, and our target price came out to be $91, which is a 13.3 potential return on the investment, but some of the stats didn't look as favorable as that.
I did look at that.
Okay, well, we did our valuation, we did the free cash flow to the firm rather than the free cash flow to equity because they have no debt. That came out to be $96 and we weighted it at 60%. The DDM came out to be $88, and we weighted it at 20%. And the relative valuation, in which we used the PE, was $81. So our target price came out to be $91, and our metrics that we use there. Sure. So kind of our three key points are the modernization of equipment that they're planning on doing over the next couple of years. They're going to be able to work more efficiently and have lower costs in the future because of the modernization. Another reason that would have been good to have this is that limestone is a widely needed material. They use it in all sorts of construction, making glass, feed for animals, cattle feed and such. So it's very diverse. And then the total reserves can sustain operations for over 60 years. And actually, after looking at the 10K, that's just one of their properties. There's other ones that can sustain it for 70 years, one that's only 30 years, but they have many different properties that all have different amounts of sustaining the operation.
So you're pitching a hold, not a buy, so why don't you start off by telling us why this isn't a buy?
I was kind of hoping to jump at, when we go over the three reasonings, essentially in the end, they have a lot of cash. They have that zero debt capital structure, and so they just sit on all this cash. They don't hedge any of the commodity price fluctuations, so they're pretty risky there. And with only 13%, it doesn't seem reasonable to take on that much risk for that little reward.
And they had consistent negative numbers over the past couple of years.
Wait, do we have this in the proposal?
No.
No.
So when you say hold, you mean like buy when it starts going?
Maybe a little bit lower, yeah, when you
Okay.
can justify taking on that risk.
So they were founded in 1948 and are headquartered in Dallas, Texas. They do have operations all over the southern states there, Colorado, Arkansas, Texas, etc. Their operation plans extract limestone from their open quarry pits as well as underground mines, and they process and sell to construction customers, industrial customers, environmental customers, farmers, pretty much anything that you use lime for. And they also have a second segment, which is a natural gas interest segment, which they have over 3,800 acres, which they hold interest on and they receive royalties from.
So a little about limestone, what it is, it's used in steelmaking, chemical and industrial applications, flue gas streaming, construction, water treatment, non-ferrous mining, which is pretty broad. So it has a lot of uses. In 2018, the leading use of it was chemical and industrial and construction applications, flue gas and water treatment. I pulled up off the USGS the average price that the different types of quicklime or hydrate lime, which USLM, they create both of these. So the price of these, they don't fluctuate wildly. The part that gets you is the fuel that goes into it, all the diesel prices and essentially running day-to-day operations. Consumption does vary, not wildly, but it does vary. Also pulled this off of USGS. Over the past 4 years there, it has gone down, but it's on a little bit of a trend back up. I think maybe part of that is due to, it's in our news section later, but it's the Obama, yeah, the fast. It's like, I Yeah, essentially it made more money available for highway and construction funds, so that kind of, I think, helped raise that trend up, but that is set to expire in 2020, so we only have really a year left of that. This goes over their total reserves, which is their kind of sustainability. So though the stars right there, it's tough to find, it's a highly competitive industry because it's tough to find high quality limestone. Unfortunately for them, these three fields that they do have high quality limestone, proven recoverable, and probable recoverable. Probable recoverable are two different things. Proven is when you drill down there and you're like, okay, this is actually there. Probable is kind of based off the geological, okay, most likely this is there. And then they give an estimated how long they can sustain operations based on what they've found, both proven and probable in there. The Colorado lime, that's a new property that they just that they haven't really worked yet. They have done a geological survey on it, but without actually drilling, getting that, they do not have a good estimate for that. That 15 years comes off of a little section that's already been mined, so based off of that, they're expecting to be about 15 years. They mined about 3 million tons in 2018. That's how much they pull out. The U.S. consumption is about 19 million, so that puts them about 16% of U.S. consumption. At the top, two-thirds of all lime production is made by just a few companies, so they are pretty small in comparison. More on that modernization, they're in the process of modernizing their Texas and St. Clair slurry operations. They're putting in a new vertical kiln at their St. Clair facility, which is their probable recovery. They just got essentially a 1,330 acre new lease, expanding that property that they haven't gotten estimates for yet. But they're expecting it to be relatively large, which is why they're putting the more fuel efficient in at this site. This should lower production costs and improve their operating efficiencies. With that lower demand, they're not utilizing all that they could. They're only using about 63% of their potential. And they did spend, in 2017, they put about $40 million into new equipment, which goes into that Texas and St. Clair there. They depreciate that straight line over the course of 25 years. Plant production, this was a little bit, so this is their breakdown of those three plants, how much each one produces over the all. Obviously the biggest one there is the Arkansas, followed by Texas and St. Clair. They did have a small operation in the Colorado line where they were bagging limestone, but that's set to expire in 2019. So that's going to get cut out of there. But the rest of the plants do have that same equipment, and they're going to be sustainable with those plants without that Colorado operation.
So the risks are the fluctuating demand. The steel, oil, and gas fluctuate with the economy, of course. And utility plants are using more natural gases instead of coal. So that does kind of hurt. Okay, never mind. They have the environmental regulations, so the Clean Air Act. A lot of what they do has a lot of environmental impact, so there's a lot of different credits and such that they have to go through with the EPA to kind of jump over those hoops. And then regionalized and highly competitive. So the consolidation in the lime industry has left the three largest companies accounting for more than 2/3 of North American production capacity, as Austin was saying. And there's high barriers to entry. There's scarcity of the high quality limestone and plants located next to markets and paved roads and railway. And of course, the mining industry is in a period of regulatory uncertainty with the current administration and Congress.
A little bit more on that Clean Air Act. So anybody that uses coal, they use limestone to kind of treat it before they burn it, help clean it up. But the more companies are moving away from using coal, they're moving into natural gas, the less limestone is actually going to be needed. So that's kind of a bummer there. So a little bit of their news, more about on that, just Fixing America's Surface and Transportation Act. It's $305 billion towards highway, rail, transportation, but that's going away in this next year here.
And then our comparable companies, I didn't have a slide for that, unfortunately. There weren't any as small as this one with a $425 million market cap. The next step was $725 million, and then went to the billions. As well as there are no other public limestone companies. They're all private, unfortunately. So our comparables, we used, a lot of them deal with different minerals and concrete and natural gas companies and copper mining and such. So I was kind of, we took them off Bloomberg, Morningstar, and Finviz, and just kind of got the best ones possible.
So I guess in conclusion, the reason we're still recommending a hole is that the trend doesn't quite seem to say that, you know, there's gonna be more lime consumption in the future. They don't seem to be really aggressively trying to grow, they're just sitting on all their capital, they don't pay a very high dividend with any of that. And so they're just kind of doing their own thing, and they don't really give any ideas of acquisitions or future property that they'd like to buy. They just say that they're open.
Do you have a stock performance graph that's a little clearer than so maybe a red line,
No, what do you want?
blue
Yeah.
line?
Yeah, oh yeah, the S&P's the orange.
This is the last year, 2018.
Yes.
And so then the one on the chart is the
It's
S&P
five.
again, the spider.
Yeah, that should be the 5, yeah.
So, I mean, this is a classic commodity, they're price takers, I don't, like, even though it's high quality lime, it doesn't seem like it's really differentiated from any of its other competitors.
Yeah, pretty much if you don't have a high quality mine, it limits the applications for it. If you don't have that clean limestone, then you can't use it for some of the more stringent applications. I think it was some of the chemical applications, you have to have pretty clean limestone, which is, it allows them to do that.
So with a commodity product, I mean, one thing that's nice about this stock is you see how low its beta is. So in that sense, it provides maybe a hedge against some market risk. And you see that a lot with commodity products because gold especially, it's more valuable minerals. But it doesn't strike me that limestone is especially rare.
It's not rare.
Okay.
It's just, well, it's not exactly, it's widely available, but finding that quality limestone is where the kicker is. And also having big enough fields where it's worthwhile to go in there and mine.
And is it expensive to transport? Is it heavy, basically?
So it's mainly transported by rail and road. They only ship within 400 miles of most of their facilities is what they said. They don't do anything international, but I mean it is.
So where are their facilities again? Can you show us that map?
Yeah. But they're,
So Arkansas, Colorado, Louisiana, Oklahoma, and Texas.
so there's their Texas line. I guess their Arkansas line. It's
Okay, so they're only willing to ship within 400 miles of any of those little dots on the map,
Yeah,
which
which-
really does limit their growth quite a bit.
Yeah, and especially since they don't seem to be trying to get out of that. I mean, we looked at, some of the other bigger companies, they have lines just across the map kind of thing.
And a number of years ago, they had been shipping their own limestone, and then they realized that it wasn't cost effective, so they started having somebody else do it. They sold off all their trucks and hired a contractor to ship their stuff for them.
Other questions? Okay, Riker?
If you guys have it as a hold, are you have like a certain price when you think we should buy it, or are they making like maybe changes, like when do you think it should be bought, if it's just a hold right now?
75 or lower is what I was thinking.
Yeah, because 75, it puts essentially the return about 20%, which is, I think you're kind of taking on not a lot of risk, but I think it wouldn't be unlikely for this company to kind of get eaten by one of the bigger companies, especially now that demand may go back down. They have a lot of cash to sit on that'll kind of help pay their bills, but if they're not growing, eventually they're gonna.
So if they have limited growth, but at 75, you think that it's reasonable for what their growth strategy is to buy them?
Yeah, they I guess for the past 10 years their growth has been like 3.3%, but it's pretty small, but I think with what they could do.
Yeah, so kind of when you're relating it back, just so it's clear in my mind, relating it back to like the three fundamentals of profitability, financial soundness, and growth. they're going to become more profitable, more or less, because of the modernization of their PP&E. Their financial soundness is, well, in a way good, because they don't have any kind of long-term obligations, but they're not really, I want to say, kind of doing anything like they have, solid enough cash flow. And their growth is kind of like, not like who cares, but it's not really doing much. One thing I would want to see as far as profitability is their operating margins and their gross margins, as well, I guess, as their profit margins compared to their other comparable companies. Of course, I would imagine that mining limestone and the other comps that you were kind of forced to choose isn't necessarily the same, but are they like vastly different to where their margins would be vastly different maybe?
We can see if it
Vastly
looks,
different, but we can look into that.
Yeah, because if it turns out that their operating margins are just, way higher, then maybe, even if they don't have that much growth and their financial soundness is kind of whatever, maybe their profitability is so good to where, hey, we should buy it.
Right.
So I like the way you're kind of structuring it in those three categories, but the last thing to kind of think about is like, a company can be very profitable and growing quickly, and reasonably sound, but if the market has already kind of priced that in, then there's not necessarily upside, so there's also the concept of value, which is less to do with intrinsic and more to do with like the valuation of the company. Based on your valuations, it looks like there might be some value here. What growth rate were you using in like the free cash flow of the firm for like revenue growth?
Is that the US GDP or US growth rate?
If that was
2.75
your
is
like
right.
terminal growth, but did you use that for your like near-term projections as well?
I don't know, I'd have to look that one up. Is
Okay.
that the one on the right side?
That's like the first thing, the first predict.
Revenue growth used was like 1.5% revenue growth.
Oh, on the left-hand side, yes, okay.
Okay, so you actually have a higher terminal value growth rate than you do a short-term growth rate,
Yes,
if
I
you're
guess.
using the US GDP rate.
If I'm thinking of
I
the right
might
sections
actually
here.
say okay, I might actually say we'd want to revisit that estimate, maybe estimate that this company is growing slower than the US GDP growth rate, just to kind of give us a conservative estimate of valuation. And like knock it down to like, look at a range somewhere like 1.5–2% also.
The growth rate, yeah, it's at 1.5 on our valuation.
So there's two
Yeah.
growth rates that go into it. There's one that's just for the short-term projections for the next few years, and
That
then
we
there's
have to
another one which is
change.
the terminal value.
Which is on the right-hand side. That one's
Yeah.
2.75, that one's 1.5.
Yeah, so like put it on like a kind of sensitivity analysis, use the charts down there to kind of see, okay, so if we change, the US growth rate, what does that mean? And if we change the short-term growth rate revenue, just
So
kind of where
I'll
does
tell
that
you, your
fall?
valuation's gonna be way more sensitive to the terminal value growth rate, the 2.75 number, than to the short-term growth rate.
Right. We
Um,
noticed
So it's an unusual assumption to think that this company is gonna grow more slowly in the next few years and then pick up to meet the US growth rate
that.
without something changing. So we probably wanna bring that terminal value growth rate down. And I think you might get a different kind of range of valuations, just to look at it.
Okay. Charles?
Yeah, you guys talked about equipment modernization a few times. Is there a timeline for that? Is it the next 3 years, the next 7 years?
so it seemed like they'd actually kind of thrown in the, because it was bought in 2017, they didn't really break it down like that, and I assume it is actually in place there. On that new kiln though, that's the one that they're still constructing. Because the $40 million that they, in expenditures, that was in 2017, so by 2018 they had that. It should be really getting into the works right now, so they should be starting to see anything on that.
Okay. And then if you look at that map, that's a company we have there at Martin Marietta. They build roads and infrastructure and things that use limestone. I think they actually have a few limestone mines in Kentucky.
They do.
Do they do any business with them at all, or?
So I think there was a couple years ago, they had sold off, our company had sold a line off to them.
Okay.
Other than that, I don't believe so.
Okay.
Impressive.
and so the comps that you guys picked here, are any of them likely to be a purchaser of this company if they do grow slower and one of the other ones gets a little gobbly?
I
Or would
think
that
of
be one of the
any
private
of them,
lines?
possibly Blackstone Minerals, but the other ones, and that was copper, that one's concrete, that one's natural gas. So I think Blackstone deals with other minerals that go into concrete, and then they also do some natural gas stuff. So that would be kind of the closest I would think.
Okay. And then you have dividend payout, is that a number or is that a ratio? Is that
That's a
per-
ratio.
percentage?
It's essentially, like Blackstone there, they pay almost half of their, not revenue, but out as dividends. Ours is still pretty low, so we're thinking maybe in the future they could grow, because their dividend's like 54 cents right now, I think is what it was.
Okay.
So they still have quite a bit of room to grow right there, especially if they're just sitting on a bunch of cash. Because they can just pay some people.
Okay. Well, I wrote a lot of questions, I guess we're talking. Looking at their tax rate for 2016, why is it low? Did they have a loss in 2015 that they carried over? Or,
The effective tax rate, that's just the new effective tax rate.
no, for 2016. So
Oh.
it was 35% corporate rate, now it's down to 21, but why was theirs 24.8 in 2016? That indicates to me they had some kind of bad business that they wrote off, or,
It just said the effective tax rate was 24.8, and then it went up in 2017, but there was a bunch of different credits that they were able to use in 2017, that's why the revenue was, or the profit after tax was so much higher.
okay.
But then, of course, the tax rate went down in 2018, but they don't have all those credits that they can.
I wouldn't read too much into the tax rate in 2016. Like, yes, it could be loss carry forwards, but it's not necessarily a sign of bad business. That's pretty common, and oftentimes, businesses usually maintain two sets of books. One that they turn into the IRS, that makes certain sets of assumptions, and another that they turn into like the SEC. They make a different set of assumptions, and that's allowed. And the assumptions that you make in order to calculate your tax liability are generally used specifically to minimize your tax liability, right?
Yeah.
So, not that GE is a great example, we all know what's happened to GE, but when I worked there, it was a company that was making profits, and our effective tax rate was around 12% at the time. So, we have really good tax accountants, that's all.
I've heard about GE's tax accountants.
Yeah, maybe they weren't as good as we thought.
They're better than business.
And then what happened with the current assets? Is that, did their just value go down because they depreciated? Because I thought you guys said they did straight line.
They do.
Or
straight
did they
line.
sell some land or equipment off? Because it dropped, I believe this is in millions, it dropped to 17 million, so.
Where are they at there?
It's the last page. I think
They got rid of a
did
bunch of
sell
stuff.
something, but I would have to look into it to make sure.
Okay. And then the sustaining operations that you guys talked about, is that for the company as a whole from each mine, or is
That's-
that on a per mine basis?
For my basis, yeah.
Per mine, okay.
Cool.
All right, any more questions?
Okay, folks, grab your brackets.